You said that what we're seeing right now reminds you of just a midlife crisis for the markets. What do you mean?
Well, the bull market's 10 years in duration. So at this point, it's natural for people to think we're going to have a bear market or a recession. But a lot of bull markets that last this long actually turn out to be super long bull markets, right? 1950 to 72 was 22 years. And then 74 to 2000, even if you do 82 to 2000, those were about 20 years. Which means at the midpoint, the market's got this huge debate. And I think that's why we had in 62, the Kennedy crash, the market kind of pulled back big. And in 87, we had the 87 crash, which was exactly at the midpoint of that bull market. And I think, 2018 is another example. I mean, whatever happens this year is going to depend on whether or not economic fundamentals deteriorate or markets had overreacted.
Even if you look at this as just a midlife crisis, I think back to 1987, a lot more pain could be on the horizon, even if you are talking about an extended bull market. You're not calling an end to any of the pain that we've seen.
That's right. I mean, the problem, I think, in December is that credit markets have continued to unravel, right? Like high yield has widened, and I think there were a lot of funding pressures in the final days. I mean, so even the stock markets rally in the final days, the debt markets kind of went haywire last couple days. But if this is midlife, mid-cycle, then long-term investors really got to hunker down because there's the market's going to be up much higher in the next 10 years. But if it's recession, I mean, we could have a deep bear market. But I don't think we're in that latter category.
Yeah, you mentioned the credit pressures. That obviously, those artificial or mechanical elements of that should be over.
Yeah, I mean, in fact,
you have
yes.
the new year, you have banks and buy-side firms, they have a full year's worth of performance and balance sheet to work with.
Yeah.
So we got to watch the credit market's response to that, right?
Yeah, this first week's going to be critical because, look, part of the reason I think equities got sold so hard in December was it's the most liquid thing. So if someone had funding pressures or balance sheet, they were selling stocks and futures. But if this doesn't unravel and normalize in January, then maybe there's something bigger.
So what would you tell people to do right now? Because that's kind of the question everybody's asking is, are we headed into a recession or not?
To me, the biggest arbiter of business cycle is 2 points on the yield curve, either the 10-1, which is still positively sloped, or the 10-30, it's just positive. We've had a weird inversion everywhere else, and I think some of that is the bank funding pressures. So I don't think there's a recession yet. I mean, in fact, it has to invert in front of a recession. But the second is, look, if there's a lesson from 2018, it's that investors can't bet big. And so I think everyone's going to start this year really cautious, betting small. And either if sentiment gets overly negative, it's going to turn out to be a huge buying opportunity, or things have to get really bad. So I think it just means start small.
What do you think happens here? Is this a situation where the market follows the economy, or where market concerns actually bring on an even weaker economy?
The level of interconnectedness, which I guess George Soros called reflexivity of financial markets, the economy is much tighter today. So the financial markets movements is the economy right now. So I think that's why the Fed really missed a big opportunity in December, because we've seen now an unraveling of credit markets, which is in response to the volatility in equity markets, and now the Fed will have to respond to that.
And the markets have already gone to the point of essentially pricing out Fed rate hikes for this year, for 19.
Yes.
Now, do you get to do that just because the stock market's down 15%? It's my sense that you really do need a growth scare. You actually need other financial conditions to get a lot worse. So it's great to say that we're playing chicken with the Fed, but it has to get a little scary before one veers off.
Yeah, we posted a chart in our last piece to our clients, and it showed basically the stock market's priced in a recession. Like every recession trade is now working. But as a fact, financial conditions have tightened a lot. High yield has widened a lot. So funding costs have changed, which means it's now raising the bar for how companies spend money. So I think there is real risk to the economy because of what happened in December.